Hello and welcome. Thank you for joining our Crittenden Finance virtual event. My name is Sarah Havlina, and I'm the editor-in-chief of our real estate publications at Crittenden Research. We are thrilled to have you here for the first of 4 scheduled 2024-2025 virtual events. Our next virtual events are scheduled for November and March. If you're a current subscriber with your renewal date coming up, make sure to renew so you don't miss out on these events. Visit crittendenreport.com for more details. Today, you'll hear from 5 industry experts who will share valuable insights on the future of CRE lending. This is moderated by Jeff Pirhalla, EVP of Commercial Lending at BankFinancial. At any time during the session, please send any questions you have in the chat, and they will answer those at the end. Now I will hand it over to Jeff.
Hey, thanks, Sarah. Thanks, everybody. Thank you to all the participants who are joining. And of course, thanks to Crittenden for hosting this webinar. We've got great panelists today joining for this discussion. We've got Justin Fordham, who's the founder and CEO of Fordham Enterprises, David Eyzenberg, who's the president of Eyzenberg and Company, Rahul Shah, who's managing principal of Sherpa Capital Group, Adam Dosskey, who's managing director of Renovo Financial, and you've got me, Jeff Pirhalla, Executive Vice President, Commercial Real Estate at BankFinancial. So before we go any further, we're just going to maybe go around the horn just a little bit. And Justin, I'll ask you to say a couple of words on what your focus is in your role, and then we'll go to David and Rahul and Adam, and then back to me.
Good afternoon, everyone. My name is Justin Fordham of Fordham Enterprises. I'm the CEO and founder of Fordham Enterprises. Our primary focus is single-family, multifamily, and also now recently commercial lending. We do have a high interest in ground-up development, and I've been in lending for the last 20 years, and I look forward to sharing my expertise with the panel and also the group.
Excellent. Thanks, Justin. David?
My turn. Wonderful. David Eyzenberg, president of Eyzenberg Company. We are a commercial real estate focused investment bank. We are capital stack, geographically, asset class agnostic, and also deal cycle agnostic. Happy to be here.
Great, thanks. Rahul, how about yourself?
Hi, everyone. I'm Rahul, co-founder and managing principal of Sherpa Capital Group. We started the company in 2010 after the credit crisis and Great Recession of 2008. Primarily because we saw a lack of capital in the market for small real estate deals. As a family office, we specialize in funding senior bridge loans in the $500,000 to $10 million range, all asset food types, all types of real estate. I have the capacity to go larger when needed. We've also done seconds and equity investments. Excited to be here on the panel today with everyone, and look forward to having a conversation and sharing our thoughts on the market.
That's great. Thank you, Rahul. Adam, you got a minute there?
I sure do, Jeff. Thanks for having me. My name is Adam Dosskey. I'm with Renovo Financial. We are a 200-person private lender based out of Chicago. Our core product is the multifamily term platform, which is a fixed rate product, 5, 7, 10 years, designed to act as an alternative to agencies and banks in the 1 to 10 million space. So good to be here. Good to meet everyone. Thanks.
Great, thanks. And I'm Jeff Pirhalla, Executive Vice President of Commercial Real Estate Lending for BankFinancial. We're a publicly traded bank. I manage the national production. Again, we're a publicly traded bank. We're a balance sheet lender. We focus on stabilized multifamily and multi-tenant office, industrial, retail properties, typically in the $1 to $10 million range. So as you can see with our panelists here, we've got a variety of disciplines, and what we'll learn more about through this is we cover pretty much the whole capital stack, all of the different debt classes as well as equity, and we'll talk about these different things. I would like to ask anyone, or just remind everyone, you've got a chat feature in there. If something comes up and you'd like to ask a question, just throw that into your chat box there, and we'll try to field as many of those questions as we can. It's nice to see not only great panelists here who we bump into at all the conferences. Nice to see them on a webinar, and then also see a lot of familiar names here coming up as the attendees as well. So let's kind of just move right into things. Let's talk maybe about the macro environment first, and then we can discuss some finer points. So I think first and foremost, what's happening with rates? I think we saw this morning industrial production came out and U.S. retail sales far better than expected. And of course, what happens? You get a run on treasuries, right? They rally. We went up 20 basis points on the 2, the 5, the 7, and the 10. They're hovering right now just around there, which is interesting because since the last Fed meeting, which was July 31, where we all know the Fed kept rates unchanged, partly based on the unemployment rate, as well as lower than expected jobs creation. Now we saw a big swing in the market. 10-year U.S. Treasury, as an example, went from 420 before the meeting to 380 as of yesterday. That's a 40 basis point drop. Also, and like I say, what a difference a day makes. This morning, based on industrial data, retail sales traders, they backed off of those bets of supersized rate cuts, and now the 10-year is hovering at 4, maybe give or take 4%. The 2-year, very similar, went from 440 to 395. Now, as of this morning, we're at 115. Still an inverted yield curve, which means tumultuous market. Based on the Fed watch, the consensus is a 25 basis point cut in September, another 25 basis point cut in November. By the way, this morning prior to 8 o'clock, that was a 50 basis point cut. Now that's back down to a 25 basis point cut. And overall, I've heard some analysts predicting a 200 basis point cut in total by the end of 2025. So I would like to kind of go around the horn with the panelists. Do you believe in this consensus? Or what's your take on it? And more importantly, how will this affect transaction volume and the overall lending environment? David, you got your hands in the debt side, the equity side, and all over the capital stack. What are your thoughts?
Yes. So I'm not a good prognosticator of interest rates, except to say that they will change, certainly during an election year. So people have always tried to sort of time the market, but the business strategy has to coincide with the lending strategy. And so you do have a lot of situations in the marketplace today where floating rate is not doing as it should, which is going down the yield curve that everybody expected, and certainly not fast enough. The drop in treasuries have pushed a lot of clients sort of over the hump to finally coalescing into 5-year money. So, massive uptick in demand for 5-year. Then you can always, depending on if you're doing Fannie, Freddie, or a bank, or insurance company, there's always the capability to do prepay or some sort of structures to get out earlier. So I think the market has just simply capitulated on that. The sizing is still not enough. And so the structured sort of capital, the gap capital that needs to go either in tandem with the senior is also sort of having a hard time lining up, because there's not a lot of mezzo pref shops that are doing 5-year money. It's usually 2-on-1 or 3+1-on-1 or what have you. So having that prepayment structure flexibility in a senior makes it work, but it's hard to get it behind CMBS money, for example, where you're going to have defeasance. So less of those structures are going behind CMBS than the balance sheet or agency money.
And defeasance now with rates, with treasuries rallying and theoretically rates coming down makes defeasance a little bit more difficult.
We just stopped midway through on a defeasance deal.
Absolutely. Rahul, I know that you're also on the debt and equity side, and you kind of play unique disciplines. What's your take on rates, and what do you think this is going to do to the environment?
Well, like David, I can't predict where rates are going or where they're going to be in 6 months, but I do know we've been talking about rate cuts for a long time, and we're still talking about the first rate cut, and we're almost in September. So if the Fed reduces by 1/4 point or 1/2 point, whatever they do, it'll help. But is it going to make a meaningful impact on lending in general? I don't know. Maybe the Fannie loans and Freddie loans and CMBS loans, perhaps. But I think the other issue that I'm seeing out there is regional banks have pulled back quite a bit from lending. So I think it's an issue of just the liquidity. Are they willing to put the money out into new loans for various reasons? So I think, a potential reduction in the federal funds rate will help, but I think the whole idea of liquidity in the market is another topic, and I think liquidity is tight. So that's my perspective, because I'm seeing a ton of refinance requests where, they're with other floating rate lenders or other bridge lenders that, they may have taken out the loans a year or two ago. And then I look at these deals today and they look very different. And I just don't see how they're going to exit some of those transactions.
But what I'm hearing is 25, 50 basis points doesn't make a bad deal a good deal, right?
That's right.
Adam, don't you think that, and I don't want to put words in your mouth or presuppose you think in the same direction that I do, but I think theoretically we have a ceiling on rates. They're starting to go down, which means it should enable pricing discovery. What are your thoughts on that?
Yeah, thanks, Jeff. Look, rates coming down is great for our industry, right? It's helping deals get done. Multifamily was stuck in a state of paralysis for the last year and a half. We're starting to see that thaw, right? Acquisitions are starting to happen as price discovery. That's all good, right? I'll echo what Rahul said. So rates are down, let's say 50 bips in the last month. Okay, so now your deal sizes to 63 LTV instead of 60 LTV, right? That doesn't much matter if you still have 72 LTV, right? And that, I think, that's the majority of deals we're seeing out there is some more leverage needed, right? And I think that's where different types of lenders come into play. So simple answer is rates down, great. We'll take it all day. But I think it's a bigger story than that with credit boxes tight.
Yeah, absolutely. Justin, what are your thoughts?
So the word for me is pivot. As rates go lower, the deals are more in abundance. As you said earlier, with Treasury, making its run this morning, I was able to get some deals in today that weren't viable last week. And that was because a lot of people were on the fence. In these instances, we do tend to look towards alternative financing. As Rahul said, regional banks have cut back. So on the non-QM side and on the private money side, so long as there's an opportunity there for the deal to be viable, we can possibly get it done. So it's about being able to pivot and finding opportunities when adversity arises.
Well, that's great, and it's a good lead-in, I think, to our one of our second topic points is how are deals getting done in today's market? Indeed, these are challenging times. What deals make it to the finish line? I think let's go around to everybody. I think first, if we can address existing loans that have upcoming maturities, are they cash in? Is anyone doing cash out? Is it neutral leverage? Are we seeing extensions, modifications? And then the opposite side of that, and it's surprising, we're seeing a lot of purchase transactions. If we believe we've hit an interest rate ceiling, does pricing discovery become a little easier? What will happen to the spread in the bid ask? Adam, do you want to take that first one?
Yeah, getting back to your example of bridge loans and maturities, deals with maturities coming up. We're seeing quite a bit of those, and we're able to, because of the way that we underwrite, we're able to get just a little bit closer maybe to that takeout amount, which is helping. With rates coming down, maybe we're closer still to paying off the principal balance without having to require, a big chunk of equity in, which is what we've seen over the last year for a lot of these folks, right? So I am very optimistic moving forward that there's going to be more opportunity for borrowers to get out of these slightly over-levered positions with bridge money.
Rahul?
So what I would say is on the bridge-to-bridge refinance requests, the first question we'll ask is, are you willing to bring fresh capital to the table and or pledge additional collateral? Most owners and developers don't like that question, but it's a quick way for us to see if the sponsor's committed to the deal and getting out of their other bridge loans. So we've done a couple of cash-ins. We've had success where sponsors want to stay in the deal. They're committed. They see light at the end of the tunnel, but they need to get out of their existing situation for whatever reason. So In most cases, we have to say no, but there are situations where sponsors are writing checks at the closing table to right size the loans. On the acquisition side, cash is king. The more cash you can bring to the closing table just shows more conviction. As a private lender who has to close loans very quickly, we keep our underwriting really simple. We're going to look for the cash component, are they experienced, and can they exit the loan? So cash gets us comfortable very quickly, regardless of the asset type, especially with the experience to back it. You have to have the experience as well.
Yep. And then David and Justin, I'd like to add another component, and that's construction as well. Is there more of a focus on yield to cost? But would like to ask both of you gentlemen, thoughts on the existing loans that are coming to maturity and then purchases. David?
Sure. So, bridge to bridge has this nomenclature because it's one bridge lender inheriting somebody else's problems to some extent, but that's not necessarily the case that's happening in quite a few deals that we had transacted in. It was not the sponsor unable to execute the business strategy. It was the financial markets not cooperating to let them sort of get to the next step for whatever reason. Or in many cases, contentions are too high. So I'm trying to think, we haven't really done one deal, which was a cash out, certainly in the last couple of years, on anything. And then everything has been either cash neutral or cash in. And that cash in could be additional collateral, or in our case, it's usually some sort of strip of mezz and pref, especially if there's juice still remaining. And this is what people don't understand. If the property is stabilized and you're sort of capped at the senior, mezz and pref coming in has no way to de-risk itself because value is staying flat. So you're just hoping for cap rate compression. So anything that's taken away at a high accrual rate is just going to wipe out the equity and not put them in a better position. It's actually very hard to get mezz and pref in those situations. Rahul's a lot smarter to just get additional collateral for those sort of transactions. On development deals, it's been kind of similar, depending on who the original lender was. If you had a bank deal, right, that was 65% leverage and you were considering it to go to mini perm, but you blew through your reserve and whatever, it is still possible to get a debt fund to do a cash neutral deal on those, right? But if you had a debt fund that was 70 plus, it is not very likely to get a cash neutral deal, and all those again required some sort of restructuring.
Justin?
So for us, what I'm seeing on the development side is, like Rahul said, cash is king. So the more money that you're able to show to keep your deal alive, we'll be able to fund it. We do see a lot of upticks for land acquisition over in the Northeast. So there's a lot of development still going. It's just a matter of making sure that that deal is viable. So I see a lot of activity within the northeastern area, and we don't really see that much of a slowdown per se. But again, the rates pretty much dictates everything for us.
Yeah, absolutely. I couldn't agree more. And David, one of the things that you said I think is very salient, and that is with mezz and with pref, you typically need some high dollar volume, right? You don't see mezz and pref at $1 million. You don't typically see it under $5 million. You see it a lot higher. So it's great when you're talking about the $20 and $30 and $50 million deals where pref and mezz are more prevalent and attractive. Those smaller deals, it really isn't there. And Rahul, I think that you probably play an interesting role there. Let's kind of, since we used the term pivot before, let's talk about that. What lenders are most active and why? And maybe our thoughts might be a little bit biased, but I think we all have a good ear to the marketplace. So if we could maybe talk about private lenders and debt funds, agency, and Adam, I might ask for you to cover those first two. And then life companies, CMBS, and banks. I wouldn't mind, providing a little bit of commentary on the bank, but private lenders, debt funds, and agency. Adam, you want to take a first shot at that?
Yeah, let's start with agency. I mean, with rates coming down, we're seeing a lot of folks taking advantage of rates with buy downs and locking in pretty nice debt, utilizing the buy down, in the mid fives all in, or even better. I've even heard about high fours lately, and that's great. The catch, of course, there's always a catch, is, does that leverage work for you, right? Because agencies, to a certain extent, as our banks, are throttling a little bit. Their credit box is tightening in ways that aren't immediately obvious, right? Maybe a little higher debt cover here in this market, maybe a little lower LTV there. But net, the bank or agency option, although the rates are fantastic, don't work for every situation out there. That's why I think now, this period, especially now and moving forward, is a great time for the alternative lenders to fill that gap and that void in capital that we see, which we are one, of course.
I can jump in on that as well. So what I would say, private lenders are active, we're active, but private lenders are also capped with how much capital they can deploy. So some private lenders may have a ton of loans on the street and they haven't gotten paid off. So that's obviously going to impact their business in terms of being able to do new loans. So that's really something that, that information's, maybe not disclosed or out in the market, but I think that's an important point. So depending on the source of capital that a private lender is using, is it really their own balance sheet, or are they using a line of credit from a larger institution or another larger hedge fund or what have you? I think there is capital in that space, but as a private lender, I know from my standpoint, we have to be selective and zone in on the best opportunities and the best risk-adjusted returns for what we're trying to accomplish. We can't do every deal that comes in. We have to pick and choose.
Right.
And I'm sorry. Go ahead.
Justin, go ahead. And then after you, I'd like to ask David to cover CMBS and life cos. I think he's got his finger on the pulse as a correspondent lender for life companies as well. Go ahead, Justin.
Sure. For alternative finance, and I believe that we kept a lot of the industry growing when we couldn't really turn to traditional financing. I mean, we were the ones that were saying yes when regional banks were saying no. And like you said, Rahul, it's all dependent on where your capital comes from and the price that you're paying for it. And that's how you can actually, cut margins and increase your deal flow. So I think that within the last 4 years, the industry has grown a lot. And Adam and I are part of a group where we have 125 of the top non-QM lenders in the country. And we grew a lot. I mean, some businesses were bought out by others, but we were still able to do deals when banks were saying no. So alternative always offers you maybe not the best price point, but at least gives you the opportunity to get in the deal. And then when you're in, you can find the right exit strategy, on the traditional side to exit out.
So what I would add, Justin, you're absolutely right. There's a lot of capital in that non-QM space, in the 1 to 4 unit residential space. So there's a ton of money there because those loans can be sold on Wall Street and securitized and what have you. But once you get outside of that, let's say, for example, hospitality and hotels. I don't know how many private lenders would get excited about lending on a hotel, but we've done some, but we're looking for certain characteristics and certain types of sponsors. So that's where, going back to my point, like, what's the source of capital? In a non-QM space, there's a lot of Wall Street money in that bucket, and that's there still. Apparently, it seems like there's a lot of capital flowing through, and also multifamily.
David, can you round this out?
I'll give you a broader perspective. I don't do anything in a single family space like the guys here, so I don't even know what QM stands for. So, but I know what CMBS stands for. So the deal cycle goes pre-development, development, transitional, and then stabilized. And depending on which part of the deal cycle the transaction sits, that's sort of where you go to touch the money. And there is different variations of liquidity and players in each of the spaces. So, for example, for the last 3 years, we've been incredibly busy in the land development space for paper. I've never seen that much liquidity ever. Right. And overwhelmingly for the first couple of years, it was coming from banks. And then when the banks got sort of shut down, a lot of private lenders that were new to the space came into the land development either as a land banking structure or as just pure pre-dev. A lot of what was driving that, as many of you know, is the affordable entry market single family home is insanely flying off the roof. That's not the right phrase, not off the roof, off the shelves, excuse me. Right. So there's massive demand for that product. In fact, some of the projects that we were doing as BFR have converted this to for sale product just because of that. And there was a lot of money available from private lenders and then some of the banks. And also to touch on the banks, it's not that the bank's not lending, they're just lending to people that can afford them in the sense that recourse and deposits. Right. So, we've done quite a few deals with banks, and as long as you have the balance sheet capacity to prop it up, and you want to save the extra 200, 300, 400 basis points, bank lending is available. Credit unions are lending, banks are lending. It's just costly in a sort of multiple factors. On the development side, debt funds, obviously incredibly active, whether they're levered or unlevered. Banks are to some extent semi-active again, but if you have the depository and the balance sheet base, insurance companies, there's now 6 insurance companies that have participating first mortgage programs where they'll give you up to 90% of the total cost, and then they share in the participation of the equity side. So that's probably up from 4 groups. And when you have an inverted yield curve, the insurance company product is kind of interesting because they're pricing over treasuries versus over SOFR, over prime, and you sort of have that built-in takeout. It's not like phenomenal. If you're just doing a construction to perm, it's not like super high leverage, but if you're doing a participating first, which is off of the treasury, very compelling economics today. On the bridge, as everybody knows, everybody's lending money. And then on the perm side, frankly, again, the issue is not a lack of money. The issue is the leverage that people are willing to or capable of getting. That's really it. This is so different than 2008 where there was no money. There's plenty of money. It's just, hold your nose and take it, or go pass the hat, around the country club and bring in some additional dollars. So that's why, the gap capital does well. And then people that have access to equity, preferably not non-institutional, are doing well also.
And what else are you seeing on the life co side? They're usually really active in my experience in the beginning of the year, and then as they get towards the end of the year, they kind of cut back.
Keep in mind, insurance companies are really doing portfolio construction, and so the CRE lending bucket is competing against the fixed income bucket. And when you were getting 200 over on AAAs, that's probably not the right number, but when you were doing better on AAAs than single whole loans, there's no reason why you would lend. And there were a number of insurance companies that are shut down for a while. It takes them probably time to get through their reallocations. But with the drop sort of in interest rates, you begin to have whole loans being more interesting on a relative return basis. So money is still there. It's very rare that when we call on, we talk to. Our job as a team here is a market maker. We talk to hundreds of groups. Just hundreds of groups, right? It is very rare. It's not that it doesn't happen. It's very rare that someone says, we're not lending. It just, does it happen? Sure, there's a few groups, but it is the exception rather than the rule. So, this myth of no money, it's not real. Otherwise, all of us would be driving Ubers today or doing something, right? So obviously there's money in the market. It's just, requires more brain damage and a little bit more tolerance to believe in the upside.
Right. And on the bank side, if I could, I sit on a couple of several banking subcommittees, and generally what I hear, and I can speak specifically as well as what I hear generally, I think banks are generally they're being more selective when it comes to CRE lending. Some are cherry picking deals, particularly those that have some balance sheet constraints. Some are lending only to existing customers, their top customers. I think despite what you hear about the impending doom and bank failures, at least from my perspective, and I look at a lot of the CCAR data as well, I believe most banks are very well capitalized. They're ready to start lending. The numbers need to work. And I think they're gearing up for a strong increase in originations in 2025. Naturally, the exception to that, of course, is banks that are heavy in office. We know that there's not a path to profit in those, and at some point you can't throw good money after bad. And I think you need to recognize what's going to happen there. And I think, unfortunately, for a lot of borrowers, that means coming into the bank with a box of keys. And I think for some that's probably a good exit strategy. For others, maybe not so much. But for us, it's interesting. We're very well capitalized. We're publicly traded. We just introduced a float down program. So your ceiling is the note rate, and you can go down 100 basis points down to 5% as a floor rate, and that happens automatically annually on the anniversary. And I don't mention this to plug the bank, but I think we're in an interesting environment where rates, we believe, are going to come down, and because we're a balance sheet lender and we hold all of our loans on balance sheet, we can be a little bit creative with that. Unlike agency that securitizes, once it's securitized, it's out there. You can't substitute it. So I think we're a little bit different. I think private lenders are a little bit different there as well. Let's talk about specific scenarios and how you think they'll play out in this coming year. And my thoughts are, and I'll roll these out first, and then I'll take a stab at it. Syndicators, right? We saw so many syndicated deals where the GP-LP structure is created. The GP owns 2% and the LP owns 98%. You wonder who really runs the deal, where that GP is the minority. I think that's one scenario. What will happen with those this year? And then other scenarios are the value add. Are there still, and I remember 3 years ago, it was rare that a deal crossed my desk that said value add. And then for the last 3 years, every deal that crossed my desk said it's value add. Are they still in play? Are there concerns about reaching pro forma? And then other topics, floating rate, and rate caps. So Adam, do you want to start with this? I know we've done a lot. And you're very, very well versed on the agency side, because you and I lived that for a good 10 years.
Thank you for your service.
Yeah, absolutely. So we've seen a lot of that, and on the portfolio side now, for me, a little bit different. I'm not really dealing with agency, but what are your thoughts? The syndicators, the value add deals, and the floating deals with rate caps.
I'll speak to the value add first. I think we talked about this before, Jeff. I stopped saying the multifamily market was frothy about 4 years ago, and then every year after that, it got frothier and frothier. So here we are. Fast forward post-COVID, where we had extra innings. Here we are now, right? My opinion is that a lot of the deals that are out there, value has already been added, and there isn't much value, not much more meat on the bone. That said, we're starting to see cost bases get reset, right? So I saw a deal in the Southwest the other day. It's finally foreclosed by a bridge lender, and that cost basis is is now back in contract with a new borrower, and that cost basis is now more realistic, and now it is a value add deal to a certain extent, right? So I think the simple answer is, moving forward, everyone's got to be very cognizant of buying right, and that's easier said than done now, when really the stress deals are really just hitting the market, right?
Absolutely. Rahul, you look, I know the space that you play in, you see a lot of these. What's your take on these?
I mean, we're starting. We haven't really done. When there was a party going on in multifamily, we weren't really participating over the last 4 or 5 years. But we're starting to see some of these deals come across our desks now, like Adam's referring to, at a lower cost basis and more interesting deals in good markets, where over the last 4 or 5 years, our money was just too expensive. We couldn't really compete. But now deals are, for whatever reason, blowing up, or, something went wrong, or someone didn't execute their strategy. So we are starting to see cracks in that space, in the multifamily space, for sure. And I'd love to hear everyone's opinion on some of these markets that have been really hot over the years. Are you starting to see a hiccup there in the Southeast, in Florida, wherever? It seems like those markets are getting interesting.
They are, and actually, we'll kind of cover that in one of the.
Sorry to jump ahead.
That's right. We're all thinking in the same direction. We're all seeing the same things. We on the panel, we have the benefit because we're lenders and we get to see everything, not everything, but a lot that's out there. So I think our perspective becomes a little bit more well-rounded. And David and Justin, thoughts on these topics?
So for the value add, I'm specifically seeing that in my area. I'm seeing where offices were pretty much knocked down and now they're built back up in a mixed use capacity where the first levels are, commercial, and then you have the added value of having the residential on top of that. So that's what I'm seeing in my market, not only from the lending aspect, but just from the development outright. That's pretty much where everything's at. And now relative to even on the residential side, I'm seeing where people are knocking down a 1 or 2 family homes so that they can build a 5-story. So kind of like to what Rahul and Adam said, you have to see the value and see some foresight within your investment to see where you can take it from where it's at.
I'll add something to that. In Chicago, for example, Adam knows this, there's a lot of talk about taking these older office buildings and converting them to apartments or workforce housing. And I think a lot of these bigger cities are talking about it. But the challenge is it's not easy to do that. These office buildings were constructed in a certain way. To just make them into an apartment building is not easy, and it costs a lot of money unless you have a true loft office type building like the loft office buildings you think of in New York City, for example. But if you're looking at these traditional office spaces, it's going to take a while to get these things converted. Maybe they'll happen with government incentives down the road, but it's not as easy as it sounds, in my opinion.
So, there's different types of value add. Value as nomenclature, right? It could be there's an operational fix that needs to be done. There's a mark to market. There's a capex. There's a broken cap stack. Broken cap stack value add is happening all day, every day, right? AB notes being structured, extensions, new cap, whatever it is, right? That's all being done, and it's so situational. It's very hard to make a broad statement over. I can make a broad statement on a couple of items on the value add side, starting on multifamily, because so we have an equity desk, right? And so it is practically impossible to raise institutional equity today for value add. And then you start dying by paper cuts. If the property has 8-foot ceilings, if the property, doesn't have sprinklers, if the property is in a market where you just had 2,000, 3,000 deliveries and there's no way you can even mark to market because you're fighting against Class A space, giving away concessions, it's very hard to execute in this business plan. So that's where you're seeing less and less. Like, the syndicators that did that all got, we know where they are today, right? And so we've certainly seen a drop off of sort of that on the outlier, syndicated value add of I'm going to whipstick on a pig and my C is now going to be like that B plus over there, which is just not possible when the A that's delivering 300 units is giving away 1.5 to 2 months of concessions. Just you can't do it. Yep. So there's been a lot of downward pressure on that business strategy. What's fascinating for me is we're closing 2 deals now that are office value add. There's been 3 funds that have been raised specifically to provide bridge or pref and note-to-note financing for office deals, right? Wow. And if you're outside of garbage markets like Chicago and New York, I can say that because I'm from New York, but lovely Miami is a phenomenal place for office deals. Frankly, very situational, but there's still money. As I went on Wall Street loves vacuum, right? And when there's a vacuum, it'll move in some way, shape, or form, and you begin to see pools of money formed, even just to capitalize on those sort of unique situations in the value add space. Right. Are we going to talk construction, or is that later?
Go right ahead.
Okay. I want to add a little bit of value, at least to the panel, from a teaching moment. So we saw something interesting. About a year and a half ago, every construction loan that we did, as it was rolling to TCO, we were like, oh man, we got to go refinance it, simply because unless you had a bank mini perm, which was 200 over, right? If you did debt fund at 5 to 700 over, it was fine when over was 0, not so fine when over is 5, right? And so there's no way that your operating reserve, interest rate, nothing was there. So we went out and we kept refinancing. And 2 things happened when you refinanced, right? You had a different floor and then you had a different spread. unfortunately, the floor was whatever SOFR or prime, whatever it was at the time, but our spreads were all coming in 200 bips, maybe a little bit more. So now when we go and capitalize a development deal, the impediment to capitalizing development deal is generally, exit debt yield to the lender, and also yield on cost affects the sponsor's ability to raise capital. So on the peripheral, there's a couple of different ways that you can help with the reduction of the yield on cost. And what we have been doing is we've not been doing 3+1s, we've been doing 2+1. And that accomplishes two interesting things. Number one, we know already that there's going to be refinance at TCO. It doesn't make sense to do it otherwise. If you do a 2+1 versus a 3+1, the heaviest part of a construction loan interest reserve is not in the first 2 years, it is in the last year when you're fully funded, right? Otherwise, you're just drawing down the bell-shaped curve of just 60%. So that 1 year of fully loaded interest reserve at whatever the ticker is today, it probably adds 50, 60 bips to the yield on cost. So we wipe that out right away. If we have mezz and pref on top of it, they're going to be coterminous to senior. That also wipes out 1 year of accrual on that. So that really helps a lot. And if you're doing a deal with a bank, most banks will let you ride the yield curve down and you can, reset it SOFR. But if you're doing a debt fund, Rahul could certainly speak to this, they're all going to try and screw you and put a floor that's pretty close to the money today, so you don't get the benefit of dropping rates. So if I go refinance 2 years later, even if I have a debt fund in place, I get a new floor. Hopefully 2 years from now, it's going to be lower, and I get a better spread because now I have a built building versus construction. So that probably wipes off 300-400 bips right there on the new loan. So that's how we're getting our development deals done today.
Got it. Let's drill down a little bit. I think there have been some questions about individual deals and underwriting and how are we as lenders looking at underwriting. So one of the questions came in essentially, and I'll paraphrase this, given the convergence of higher operating expenses, certainly real estate taxes and insurance, and higher interest rates, are lenders being flexible if a borrower fails a DSCR covenant, or are lenders giving borrowers time to seek alternative financing? Is there a heavy-handed approach? Foreclosure, for instance, deed in lieu. I know that from my perspective, on our bank side, we have a lot of hybrid arms where we have a fixed rate, and after the fixed rate period, we'll do an adjustable. Agency, certainly similar to that. You're great when you're in the fixed rate period, but then your rate goes from 3.95% to 7.5%. Needless to say, that impacts NOI and debt service coverage. I think from my perspective, at least with our bank, we're very watchful of this before it happens. We look at rate resets and we try to work with borrowers. I think it comes down to both a regulatory decision as well as a business decision. But I'd like to put it out to the panel, like what in your particular disciplines, how are you working with borrowers that have some financial distress, particularly your break-even NOI or your negative NOI? You can't hit a covenant.
Yeah, Jeff, I'll take that one first. On the operating expense side, as it turns out, inflation has not just increased the cost of eggs and milk, but it's also hammered operators on repair and maintenance, obviously insurance and everything, right? What that means today is if you are a traditional lender in the traditional cohort of lenders, banks, agencies, and you take the same view of underwriting that you've taken over the last cycle, which is a look back approach, you're going to be, our opinion is you're going to be over penalizing borrowers for what could be sort of a more temporary threat, rise in expenses, right? So what we do, something a little bit different, and here's what some alternative lenders are doing, which is why we're filling that void, is we're underwriting today's rent roll. We'll apply market rent to a few vacant units, and we're going to lean hard on the appraiser's expenses, which is more of a midterm view of where expenses will shake out. And we believe that's a more realistic approach to underwriting expenses. As a result, with our program, we underwrite on at 125 on an interest-only basis. So as a result of all that, we're able to squeeze out proceeds that might work for the borrower versus the traditional cohort of lenders, right?
Absolutely. Rahul, what's your thought there?
I guess, when we make a loan, our loans are short term as an alternative or private lender. Our loan terms are anywhere from 6 months to 12 months, 18 months. So once we make the loan, we're pretty hands-on from the beginning. So depending on the type of deal it is, we're watching, we're monitoring, are the payments coming in? And we tell our clients, if there's any issues, we want you to communicate those to us. If you need some sort of concession or help, we want them to get to the finish line and succeed. But the communication is key. Now, an apartment building deal that's being updated and the units are vacant is one type of deal versus, a hotel that's doing okay and they're turning it around. So it just depends on the type of asset as well. But I guess the global comment from our standpoint is we're hands-on. We want our borrowers to communicate with us if there's an issue or they're getting hammered somewhere else on a deal and it's affecting their ability to service our loan. So as long as they're staying in touch with us, we'll roll up our sleeves and try to help them in whatever way we can and find a solution. But the borrowers who just run and don't communicate, those are the ones we're trying to stay away from.
David, I'm curious, you see different parts of this. Are you seeing any lenders really being heavy-handed if there's a path to economic recovery? I get it if it's the over-levered office building and there's no daylight. Are you seeing anyone being heavy-handed? The specials, any particular lenders?
So we worked on a bunch of CMBS workouts during COVID, and it was just horrific brain damage. And actually, we won't even take that business because the special services have a different motivation. It's not economic. So all of our workouts today have been on balance sheet, and it's been absolutely fascinating to see how open to extensions and accruals they are. Because marking down one loan is a sign that the rest of the portfolio, right, has issues, and so you start. Well, actually, a couple of things, right? If a loan is non-performing and it's sitting on a line, and if you have money from Churchill, right, or I shouldn't have used the name, but you have money from somebody, right? You got to buy it back, right? Whereas if you restructure and do an A/B note and sort of accrue some stuff, it's still performing. You can keep it on the line. If you're a public company and it's performing because you did an A/B note structure and all your junk and accrual and unpaid stuff is sitting in the B or the mezz, it's performing. So we've done a number. More than 10, I would say, right? Restructurings where the lender was willing to extend. We are having a hard time in certain situations where it's clear the lender's at 101% financing, and new capital doesn't want to come in to sit behind 101, and we want to split it up, and they're saying no, just keep it going, fund the reserve, and sort of continuing to pushing it out. So substantially less willingness on lenders to take write-downs, much more to structure and just kick it down and hope things get better.
Got it. We've got about 10 minutes left. In the interest of time, we do have a couple more topics, and I'd like to remind the participants, if you've got any questions, type them in the Q&A. We'll try to get those answered as they come in. But I'd like to just kind of cover these, and maybe if we can give some answers with some brevity so that we can get through these, because I think they're salient. I think they affect how deals get done. How do rent concessions and projected vacancy and rental rates play into the market going forward? And are you seeing a significant difference between physical and economic occupancy? And I'll just ask everybody to be brief. We probably have about 10 more questions, and I'd kind of like to just get a barometer approach from everybody.
The answer in some markets more than others, Jeff. There's two worlds right now. There's markets that are oversupplied or way oversupplied, and those that have almost no supply. So Tale of Two Cities, and those oversupplied markets that still have 30,000 units coming online, and they're already sitting at 1 or 2 months concessions. That's going to be a challenge. But other markets, smaller markets, are doing just fine.
Yeah, I think there's a lot of, and you're right. And Adam, I would add to that also the classification, right? Class A, you've got a lot of units coming online. So Class A is definitely going to take a hit. Class B, Class C, particularly in tertiary markets, they seem to be faring quite well. But the more reports that I read, the more I see rental rates kind of ticking down, concessions ticking up on again, broad brush. David, what do you say about that?
Same thing. We just had a bunch of construction loans that were delivered over the last year plus, and like in markets like, two stick out now because we're playing with them. One in Huntsville and one up in Daytona in Port Orange. Underwriting was half a month of concessions, and in the end, you were probably 1.5 to 2, depending on what. And what's happening is, these markets have absorbed. I mean, they all absorb. A lot of the deliveries are sort of being finished up, and the market is saying that you're going to be able to push rents probably within a year because there's not a lot of deliveries today. So you went through a 1 to 2 year gap of deliveries. Mm-hmm. Market's okay.
Right.
Subject to great, broader economic shenanigans.
Which kind of ties into the next question that I have is, how do you model the next 12 to 24 months in terms of rental rates and occupancy and concessions? Rahul, how are you looking at these things? And you're really hands-on. I know you know all your deals really well.
We're going to back the best sponsors with the best strategy. And going back to my comment earlier about the cash component and the equity component, that's their job. The nuts and bolts are really the sponsor and developer's job to get to the finish line. And, we make a calculated decision on, do we think they can get there? So it may sound like a very, sort of wishy-washy sort of response, but, we see all types of deals that people should not be doing or should not be in, but, they're able to get money elsewhere or someone gets them the capital. But we really focus on the upfront diligence and the upfront underwriting, and things always don't go the way we plan or the way sponsors plan. But I think we've been doing this long enough where we've gotten good at it, and we're also doing smaller deals. So I think that's the other thing. It's like the 4 C's in banking or whatever. The character and the collateral and all that sort of fun stuff. Those things matter today, especially when you're lending out your own capital, and we want to see that it comes back. Sometimes It's very easy to make a loan, but difficult to get paid off.
So overall, and I'll kind of piggyback this on the next question is your credit box tightening? And it's odd because we're in theoretically a falling interest rate environment right now, which makes things a lot better. But from what I'm hearing,
absolutely. Yeah. Yes, for us. Yeah, absolutely. We're more selective.
Is the credit box tightening? Yeah, it is. Depending on, the traditional lenders are definitely tightening, especially banks, agencies, and other ways are not obvious. That now is the time for alternative sets of lenders to come out and take advantage and fill that void. So, we're getting our start with this new product sort of post cycle or early into the new cycle. We feel like we're well positioned to be a little more aggressive than the folks that have a lot of exposure to the last cycle.
Yeah. David, your credit box?
So on the mortgage banking side, we just follow. We don't do trending, right? Mm-hmm. So it's just whatever's in place. We underwrite, and we assume normal escalations, and we don't think ever that rents go above expenses on escalations. From the credit fund side, that we have an affiliation through Reeds Bay, same sort of concept. For us, it's we never want to. My view on credit is very simple. I never want to hope that the market gets to me. I kind of want to get to the market, and that was how I was trained early in my career, and so that's just how we do underwriting. On the investment banking side, I drink the Kool-Aid, of course, and I pitch upside and all this other good stuff. So it depends on what hat I'm wearing.
Yeah, I'll tell you, from the banking side, we'll if we have a loan request that's pushing up against a guideline or a requirement or some exception, we'll do a credit memo, and essentially that's a quick underwrite that is in a memo format, and it goes to loan committee so that they may opine, and that determines whether we issue an expression of interest or an LOI on a deal or not. I could tell you 2 years ago, I would maybe 1 out of 20, 1 out of 25 deals. Now it's about 50% of the deals we're doing credit memos. So our credit box definitely is tightening. Justin, do you concur?
Yeah, I totally agree. Our credit box is tightening as well. However, we want to be in a situation where we're proactive and not reactive. So our success really lies in the being cautious and our due diligence to the approach of what we're trying to fund.
Great. My last question, and I think this is kind of interesting, is because I see it all the time, and unfortunately, we're not able to really help on this. A lot of lenders are requiring stabilization and seasoning. Borrowers, I hate to use the term, they want some skin in the game. Adam, from your perspective, you're kind of more traditional on that scale, and you've got a platform. You're not really requiring seasoning and stabilization like we did on agency. Is that correct?
Yeah, right. We take a little more, for lack of a better word, progressive view on underwriting. We're not going to do every deal that's not 90% occupancy, but as an example, we can, if we have a deal that's 80% occupied, we have no problem applying market rents to the last few vacant units, because it's okay if the property blipped in operations today. We're not going to penalize the borrower. So we think it's that level of flexibility that our borrowers really appreciate, especially in this environment.
And Rahul, you on the private side, is it more if it makes sense, you'll do it, but you don't necessarily require the stabilization and the seasoning?
Yeah, that's right. We're more of an asset-based lender, right? So we're making a bet on the story and the execution. So the cash flow is not necessarily, we're not looking at all that as much. It's important. Want to make sure it's feasible or doable, but we're betting on the sponsor and the strategy.
Great. We've got some great disciplines here. I hope that we provided a broad range of answers, and I hope we covered some questions. I want to thank these amazing, very insightful panelists for their willingness to participate with their expertise and their experience. I'd like to also thank Crittenden for hosting this webinar, for their continued role in providing informative and important conferences and events that I believe are vital to our industry. I'll turn it over to Sarah for some closing comments. Sarah?
Thank you so much to all of our panelists, and thank you again, everyone, for joining our very first Crittenden Finance virtual event. Again, our next events were scheduled for November and March virtual events. Thank you again. Have a great rest of the day.
Thanks. Thank you, everyone.
Thank you, everyone.
Yeah.